Welcome to a Mode, a platform where young ladies come to get motivated. Today we shall discuss the 8 basics of personal finance to help manage your finances, dear ladies. So, does the prospect of managing finance gives you cold feet? We started developing interest in managing our money when we first started working. Suddenly, we found ourselves having a steady paycheck but unequipped to manage. It took us a lot of research to understand how to go about it. A financial plan is a roadmap that helps you achieve your goals. It also paints a comprehensive picture of your current finances, your financial goals, and any strategies you've set to achieve those goals. Good financial planning should include details about your cash flow, savings, debt, investments, insurance, and any other elements of your financial life. What is financial planning? Financial planning is an ongoing process that looks at your entire financial picture in order to create strategies for achieving your short and long-term goals. Creating a financial plan is important because it allows you to make the most of your assets and gives you the confidence to weather any bumps along the way. Let's decode the basics to gain a deeper understanding of how they work together to lay a solid financial foundation for you and your family. 1. Set financial goals. A good financial plan is guided by your financial goals. If you approach your financial planning from the standpoint of what your money can do for you, whether that's buying a house or helping you retire early, you'll make saving feel more intentional. Make your financial goals inspirational. Ask yourself, what do I want my life to look like in 5 years? What about in 10 and 20 years? Do I want to own a car or a house? Do I want to be debt-free? Are kids in the picture? How do I imagine my life in retirement? Having concrete goals can make it easier to identify and complete the next steps, and provide a guiding light as you work to make those aims a reality. 2. Start tracking your money. Get a sense of your monthly cash flow. What's coming in and what's going out? An accurate picture is important to creating a financial plan and can reveal ways to direct more to savings or debt paydown. Seeing where your money goes can help you develop immediate, medium-term, and long-term plans. For example, developing a budget is a typical immediate plan. Reducing credit card, student loan, or other high-interest debt is a common medium-term plan, and planning for a house. Kids' education and retirement is a typical long-term plan. 3. Budget for emergencies. The easiest budgeting technique is the 50-30-20. This works by allocating 50% of your take-home pay toward needs like housing, utilities, transportation, and other recurring payments, 30% toward wants like dining out, clothing, entertainment, and 20% toward savings and debt repayment. The core of any financial plan is putting cash away for emergency expenses. You can start small to cover small emergencies and repairs so that an unexpected bill doesn't run up credit card debt. Your next goal could be 1 month's basic living expenses, and so on. Building credit is another way to shock-proof your budget. Good credit gives you options when you need them, like the ability to get a decent rate on a car loan. It can also boost your budget by getting you cheaper rates on insurance and letting you skip utility deposits. 4. Tackle high-interest debt. Pay down high-interest debt, such as credit card balances or payday loans first. Interest rates on some of these may be so high that you end up repaying 2 or 3 times what you borrowed. If you're struggling with revolving debt, a debt consolidation loan or debt management plan may help you wrap several expenses into one monthly bill at a lower interest rate. 5. Plan for retirement. Retirement savings needs to become a priority instead of an afterthought. If you're not saving for retirement yet, revisit your budget to see if you have room to include it. An old rule of thumb says you'll need approximately 80% of your present income in retirement. However, this assumes that retiring will free you from any work-related expenses and taxes, that you paid off your mortgage, and that your children will be financially independent. If you're saving 20 to 30% of your pre-retirement income, then the 80% income replacement rule is a good place to start. Otherwise, it's safer to aim at covering 100% of your pre-retirement income, less whatever you're saving for retirement. As with any general rule, there are plenty of exceptions. So be sure to sit down and fine-tune your retirement budget as the time draws near. This should be your top priority, since you can borrow for most other goals, but not for retirement. 6. Emergency funds. When something unexpected happens, like you lose your job or get hit with an unexpected medical bill, an emergency fund can help you avoid tapping your long-term savings to make ends meet. It's generally a good idea to save enough to cover at least 3 months' worth of essential living expenses like groceries, housing, transportation, and utilities. If you can manage 6 months, it would be considered ideal. Save this money in a highly liquid checking or savings account so you can access it in a hurry should the need arise. 7. Insurance coverage. Insurance is an important part of protecting your financial downside, but you shouldn't overpay for coverage that you don't need. In general, you must have health insurance. Without it, even routine care can cost a pretty penny, while a serious injury or hospital stay could set you back by tens of thousands of dollars. Disability insurance. This coverage protects you and your family in the event you're unable to work. Auto and homeowners insurance. If you own a car or home, make sure you're adequately protected. Life insurance. This is generally a good idea for those with dependents. Work with an insurance agent to understand what type of and how much coverage makes the most sense for you. 8. Estate plan. At a minimum, you should have a will, which states your final wishes with regards to your assets, dependents, and who you want to administer your estate. You should also keep the beneficiaries of your insurance policies and retirement accounts up to date. Also consider establishing powers of attorney for financial and healthcare decisions, in the case you become incapacitated. For help getting started or tackling more complex estate planning tasks, consider working with an estate attorney or a qualified financial planner. Once your basic needs and short-term goals have been addressed, a financial plan can also help you tackle big-picture goals. Thoughtful investing, for example, can help build generational wealth, and careful estate planning can ensure that wealth gets passed down to your loved ones. Financial planning can help you feel more confident about navigating unexpected situations like unemployment, a recession, or historic inflation. People who have a written financial plan feel more in control of their finances compared with those without a plan. While there are many ways to go about developing a plan, one way is do it yourself, work with a financial planner, or a combination of both. It is very important, especially for women, to be able to handle their finances on their own. With careful study and planning, and after taking adequate steps, a person can be financially independent and enjoy their life to the fullest. Do comment below to let us know what steps you have taken to make yourself financially independent. Thank you for watching Ola Mode. Until next time. Bye.